Property prices are falling, but you're not paying attention to the right stuff. CBA's just revealed some data points that you need to pay attention to, especially over the next 12 months as you navigate through the volatility, which is often where the opportunities lie. So let's dive into what's actually happening on the ground floor, regionals versus capitals, and I'm going to also reveal the best regional locations to have a property in if you are maximizing growth over the next 12 months. Now, if you're new here, my name's Ravi and I've been building a portfolio for over the last 12 years. I've also amassed a portfolio well in excess of $25 million. We've also just crossed over $1 billion worth of real estate across the last 6 years at Search Property. So if you want to know about what's happening on the ground floor, smash that subscribe button, hype this video up, and let's dive into it. So first up, we're looking at the PropTrack Home Index for June 2026. Australian home prices fell in June as all but one capital city recorded a decline. Despite dropping a further 0.3% during the month, prices remained 5.8% higher than a year ago. We already know that prices are starting to accelerate on the downfall, and when I say accelerate, do not lose your mind and get too excited because the falls are really nothing. What I wanted to focus on was this. In the teal color, we have regional areas, and then in the red, we have capital cities. And as I've said on the channel year after year for the last 6 years, the regional markets is where you want to be in, because that is truly the blue chip areas, especially when it comes to affordability and long-term growth. In fact, if you went ahead and actually looked at some of the blue chip areas in Sydney alone and compared that to some of the regional areas, you would find that the regional areas have outgrown those blue chip areas, but that isn't sexy. No one wants to talk about that. They all want to talk about the Bondis of the world. Now, what we can see here is a sharp decline in the capital cities, but regional areas are holding up relatively well. Now, in saying that, we're starting to see that downtrend, and we probably will see a flat market over the next 3 to 6 months. So if you're buying in this market expecting that I'm going to get some equity growth straight away, well, based on a chart like this, it shouldn't be expected. But that's when you dive deep into LGAs and you look at some of these suburbs. And while many locations like Sydney and Melbourne, when you see those numbers come up, will say over the last 12 months, they've grown by 5 to 7%. There are some suburbs right now that we've been purchasing over the last 12 to 18 months that have recorded 20% worth of growth. And I'm not just saying these are areas that might have a short-term blip. They're actually blue chip areas. It's just that people aren't really paying attention to them. According to The Economist, let's see what the outlook is, and then we're going to dive into what CBA is revealing as some data points that we need to pay attention to. While home values were down in most capital cities over June, prices remained high in every capital city and regional area except for Melbourne compared to a year ago. Several factors will impact the extent to which home prices move over the second half of 2026. While there is still the potential for another interest rate rise before the end of 2026, expectations of additional hikes have moderated. Once it becomes clear interest rates have peaked, this is likely to see confidence improve among buyers. What's also really interesting is we're now starting to see the downturn in approvals as well for new properties. So Australia's housing industry says more needs to be done to lift building approvals, with the country's now 2 years into 1.2 million home housing accord target. According to seasonally adjusted data from the ABS, building approvals for May 2026 actually fell by 1.1%, following a decline in April. Much like April, the fall was largely driven by a 10.4% drop in private dwellings, excluding houses, which includes townhouses, apartments, semi-detached, row, and terrace houses. Overall, the May result for the category was 8.6% lower year on year. Meanwhile, approvals for detached homes lifted 2.8%, the highest level for the category since September 2021. That is some good news. Western Australia continued strong growth in detached housing approvals, rising 9.9% to be about 24.5% compared to May 2025, which is actually phenomenal news if you're looking at affordability. But the true story here is that if you look back over the last couple of years, all these approvals that happen to come into the pipeline, there's a large majority of them that never make it to completion. And there's so many reasons for that. Obviously, people can't get finance. They might have a project approved, but they don't want to complete it. And then you have a bunch of insolvencies, record high insolvencies among the construction industry. So there's a chance it gets approved, but by the time you actually want to complete it, the builders have actually gone bust. While the ABS figures only report progress to the end of May 2026, industry groups said the latest data highlights the scale of the challenge. Master Builders Australia Chief Economist Shane Garrett said annualized data pointed to a growing shortfall. Annualized data shows a 91,000 home building shortfall has marked the Accord's first 2 years. The volume of approvals for new homes has been consistently below its long-term trend over the past 2 years. New home building activity across Australia was at its strongest during the mid-2010s. Then we have had favourable mix of settings involving low interest rates, solid productivity, economic stability, and an openness to foreign investment. However, we still do not have enough properties right now. That is a fact. Are we going to have enough properties in the next 2 years? Absolutely not. That is also a fact. And while we're on facts, it could actually get a lot worse. So while a lot of people are in this camp of, yes, prices are going to come down, this is such great news. When you've introduced a deadline for SMSF borrowing for residential properties, you have negative gearing changes, you also have capital gains changes, and you've also had that all come off the back of 3 rate hikes. When you have this combination, it's the perfect storm for a further shortfall in housing. Now, while in the short term, we can see prices go down, people are freaking out, and that's just natural. It's just how cycles play out, it's consumer behavior. But what's going to happen off the back of this is that you're going to see the uncertainty turn to certainty, especially when a lot of the things that we've been talking about on the channel actually play out. And I know that's not going to be the news you want to hear, especially for the 5 people that continue to hate in the comments over the last couple of months, hoping that prices crash by 30%. One of the main things that we focused on was rental growth, and rental growth is now at its strongest point over the last couple of years, and that is only heading one way. So while it looks like in the short term, yes, house prices might be dropping, they're dropping by 0.5%. It's nothing to write home about. But could we see peak fear already in play? Yes, because consumer confidence is starting to increase. As we said it would play out, is that all this pressure is inevitably going to find its way into unemployment rates, and then of course, the RBA not having to hike rates anymore. Now at this point, could we see another rate hike? Potentially. But what the market's really starting to look at is 2027, a recession in Australia, which would mean sharp cuts of the interest rate. And post every downturn that we've seen over the last 50 years, we inevitably see the upswing of the market as soon as the interest rates start cutting, which at this point is tipped for 2027. Could we see a sideways market for the next 6 months? Potentially. And honestly, that's how I would be preparing for this. Go in there, get what you need, set the assets aside, get the strategy in play. This is the time you'd want to be doing it. Because once you get into 2027, and if interest rates do drop, people are going to start realizing interest rates are dropping, so people's ability to borrow increases, rents are increasing, so now yields are starting to improve for residential investors, and on top of all of that, you don't have enough homes. And people will realize that in 12 months from now, because honestly, if you think you have no confidence to buy an established home right now, who in their right mind is going out there and building a new home? Absolutely no one. What's also really interesting is what Commonwealth Bank came out and said with their Regional Movers Index. So the Movers Index is the capital city movement to regional Australia, which is the highest on record. And we can see it here break down. Regional to regional is 12.7%. From capital cities to regional is 11.9%. And then if you see from regional Australia to capital cities is about 9.2%. So vast majority is going the other way, which is towards affordability. So where are they all moving to? What we have here is the capital city net outflows, regional area net inflows. What we can see here in the yellow is vacated capital city, and then what you have in the orange is the settled in regional. And you can see how many people are leaving New South Wales, 34% are going regional New South Wales, but here is the big story, Queensland. 1% vacating the capital city, but it's 20% that are going into regional Queensland, which is no wonder why we have so much growth in regional Queensland, and we'll continue to see those numbers. What we also see is in Western Australia, no one's leaving the capital city of Perth, but there's a bunch of people going to regional Western Australia. So here we have it, the top 5 LGAs by share of total net migration to regional Australia. The Sunshine Coast, number 1. Number 2, Greater Geelong. Number 3, Fraser Coast. Number 4, Maroubal. Number 5, Lake Macquarie. I have told you on the channel, one of my favorite locations is Geelong. It is in high demand, and if you go onto the ground floor there and you saw it in isolation, you would say, I don't think there is a market collapsing here. I think the market's got a lot of pressure underneath it. The other thing that we can look at is the top 5 locations by annual growth in net capital regional migration. So this is the percentage change. So we've seen Toowoomba at 236%, Broome at 168%, Townsville at 159%, Clarence Valley at 144%, and Indigo at 133%. I can tell you now, as part of the buyer's agency, we have definitely bought into Toowoomba and we're definitely bought in Townsville. I personally have properties in both of those locations, and the big thing about Townsville is that they have such a chronic shortfall in terms of housing supply. They also have seen construction costs increase by about 20% in that location. Now, why am I sharing this all with you? It's because I've said to you time and time again, you got to get into the affordable markets if you're looking at investor stock. If you're going in there and trying to build a portfolio, don't worry about the flashy blue chip areas. What you want to be focusing on is long-term data that backs these long-term assets. That is where you're going to get the most gains. I've often been called a regional fanboy on this channel because I built my entire wealth off the back of going out to the regional areas and building my wealth there. And what I mean by regional areas, I'm not saying in the middle of nowhere. I'm also not saying go into an area that is just dependent on one industry when it comes to employment. What you want is a diversified location. I've also really liked the smaller capital cities. So looking at somewhere like Perth, we've actually made a lot of money for clients as well. If you want to be one of the handful of clients that we take on every month, then definitely use the link in the description box below. You'll find a link. You'll be able to book a completely free call so you can ask your thoughts and we can see if there's a synergy for us to help. And there's also mortgage brokers, Refine Loans there, and they're going to be able to help you get all your finances in check. The key takeaway from all of this is that if you listen to the headlines, which is a generic headline made for the entire market, it will tell you that we're slowing down. And that is true. That is the fact. But if you were to go out there and cherry pick some suburbs, you would see that we've seen an absolute boom and it's continuing to gain momentum while we only see one thing change, which is supply going down. So if you based it on those markets, you would say, oh my God, the Australian property market is absolutely tearing it and it's currently in a boom. And this is the reason why it's so polarizing, because I can come out and say the market's actually pretty good in the markets that you want to be in and not so good for all the other markets. And people in the comments are like, this guy has no idea what's going on because in my suburb, it's going down. No one wants to buy property. And that in turn actually highlights my exact point. This is the time where you don't want to be complacent. You don't want to just go out there, wait for a market to hopefully go and crash by 20 or 30%. Chances are they may not. What I would prefer to do is diversify my portfolio, be a borderless investor, go and pick up the properties where you need to, so it allows the market to do its thing. At any given point, there is at least one property going down in my portfolio, and that's even over the last 5 years. But at the same time, 80 to 90% should always be moving up. And that is how you would diversify your risk, mitigate that risk, especially when you're all in to property. If you have enjoyed this video, you need to subscribe to the channel because over the next 6 months, you need to be paying attention. You need to move at speed when the time is right. I'm going to do my best to cover it all off, just like I did during all the lockdowns. And then we can reference this video in 12 months and say, hey, told you it wasn't going to collapse. You shouldn't have just hoped. Have a strategy because hope is not a strategy. If you have liked this video, smash that like button and I'll catch you guys in the next one. Thanks guys.